Hi everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look through Twitter, see what people are talking about on social media. Obviously, I put some posts up myself. We can go over those together. I'm going to give you my financial opinions. It's going to be related to wealth building, commodities, or financial topics that we're going to talk about. So let's dive in here and take a look and see what I've got for store for us. Again, it's at finding_finance if you want to follow me, or you can join our community at finding-value.com. We do have a special going on for October 30th and the 31st called Spooky. Spooky. Look in the comments, the description below to see what those details are. So first I'm going to start with, tell me how these dates all align. Commodities boom, anyone? So this is U.S. stocks versus bonds returns. And what happens is, at the beginning of a commodity bull market, a big one, what happens is interest rates generally go up. And when they go up, they usually cause bonds and stocks to fall at the same time. 1931, 1969, and 2022 all had bonds on U.S. bond return negative and U.S. stocks return negative. That's kind of the precursor of what's to come. Money rotation. Think of money rotation, increasing interest rates from inflation, and then the following portions that came. But these are what kicked off commodity booms. These two were inflationary. This one was not so much inflationary, but they did increase the gold price, which effectively repriced commodities upward. So think of 31, 69, and 2022. 31, where commodities were cheap against stocks. 69, commodities were cheap against stocks. And 2022, we're down here as well. We just don't have the 2020 there. So each one of these, before these big bull markets, in the 30s here, that was a gold price revaluation, the big bull market here, and what I think is going to be a very big bull market in commodities, all sharing the same traits at the beginning of the bull market that we have going on. Also, 1931 was this peak here. That was actually 29. 31 is slightly after. So 29 to 31, all in this area here. The beginning of that, 69 was up here. It was coming back down. And then we've got 20, 21, 22. It's coming back down. So the stock market underperforms the producer price index under these market conditions. And you can see the sideways movement during those time frames. What happens during those time frames is a rotation of money away from financial assets, away from bonds and stocks, and then it starts to rotate into commodities, causing commodities to outperform. And we've seen that outperformance in the ratio of commodities to stocks here recently. So that's all of it tied together there. Ali says, and this is going to be more data supporting the rotation of this money above it, because interest rates are what cause a lot of that rotation. Had a gentleman tell me today he believes the federal funds rate goes to high 6, low 7%, and the Fed holds there for a couple of years. What do you think? Well, I think that makes sense. Why do I think that makes sense? It's because the demographic of the millennials are coming into home buying years. The Federal Reserve has to slow down the inflation from that demographic. So he basically, what he needs to do is he needs to pin down the housing market, which is a creator of fractional reserve lending credit. So the credit coming into the system from that demographic buying homes is going to create inflation or credit growth. Credit growth is inflation. In order for him to slow that down, he needs to hold the federal funds rate up, the short end of the curve up, and he needs to hold it there for a while because of the demographic coming through. So he's going to have to hold it up there for at least a couple of years. Now, what happens when he does that? I don't know. I don't know how the government is going to run deficits as large as they are. So that is where they get pinned into a corner. There is no solution for this problem because he's in a predicament. A predicament is where you have to handle outcomes. You don't have a solution. So this is the problem he's in. If he raises rates more, like this person talks about, they bankrupt the United States and we get runaway deficits with interest payments, the interest expense. If they lower rates because of the interest payments, then your housing market explodes and credit expands from there, and you get really bad inflation. So he's kind of screwed any way he goes here. There's no good option. So he has to handle outcomes instead of having a solution. Now, I'm not a big fan of Wall Street silver, but I will say this. This person made a comment. My son, 25 years old, still lives with us at home. He laughs off the idea that he will ever own a house like the one he lives in now. Trudeau's answer is basically more government programs which do very little to address the problem. But what he did say is that he needs to build a lot more homes. If they build a lot more homes, it's going to be very inflationary. And the building of the homes and the credit against those brand new homes is where the inflation is coming from. This is HFI research. Right in between 2021 and 2022 is the U.S. Big Four storage. This is inventory levels. And as you can see, 2023 is right in between 21 and 22. So we are on the low end for inventory levels of the Big Four. Charlie says, U.S. housing affordability is worse today than the peak of the last housing bubble. The median American household would need to spend 44.6% of their income to afford the median priced home, a record high. Now, here's the thing. That is a false. The median priced income is not buying the median priced home. So even though they may have this metric here, what this is describing is the shortness in the market. As markets become way out of balance, they need to price people out of the market. And the median income would get priced out of the market in a very big shortage. So what this is indicating to me is that we have a shortage of homes. The next question I would ask is, okay, we have a shortage of homes. Existing inventory is low. We have new homes that are going to be built, and the affordability has moved in a way where it needs to price a lot of people out of the market. What is the price of new homes coming on the market? And if the price of new homes coming on the market is very expensive, which I think it is, then how do you actually build your way out of it? What if the medium income family can never afford to buy a new house? Or what if the majority of people are not like 75%, greater than 50%, let's say 70% or something, cannot afford to buy a new house? And if people are not, if they cannot afford to buy new homes, well, how do you get more volume into the market? That's a weird question, right? It depends on your cost curve of your new homes and what people want to buy for new homes. If new homes are too expensive for the majority of people, how do you get more inventory of affordable homes? That's a great question, and I don't know the answer there. The Big Seven becomes the Big Short. Microsoft, Nvidia, Amazon, Tesla, Apple, Google, and Meta all down. Is this the beginning of the peak where things start to roll over? It could be. For the NASDAQ companies, it very well could be. And that's that rotation of money from growth stocks into commodities and eventually precious metals. Breaking, the U.S. Mint takes delivery of 100 plus million in gold and silver in the past 3 days, setting the stage for a record delivery week on the year. That's crazy. So Alexander says, from Charlie Munger, the big money is not in the buying or the selling, but it's in the waiting. It always has been in the waiting. So what are you going to do? If you buy a good company at a good price, are you going to sell it after 100% gain, or are you going to have to wait for 5 or 6 or 7 or 8 years to get the 10 bagger that you want? It's up to you guys. You're going to have to wait, and that's where the money's made. Somebody in our network of investors recently informed us about a huge technical challenge, read losses, for sea-based wind farms. This seems to confirm it. It looks like there aren't many winners in the green energy transition. Siemens Energy falls as much as greater than 30% to a fresh all-time low as the wind turbine firm seeks state guarantees. Wind turbine units stop taking orders for certain platforms. Net losses, cash flows expected to exceed market forecasts. And there it is, diving to the downside, breaking support. So these renewables are not profitable. And even the subsidies are not making up for it. As commodity prices continue to increase, I have a feeling that a lot of these renewables are going to go to the wayside. They're not profitable. And they're going to become less profitable as energy becomes more expensive and commodities become more expensive. Oil tanker rates are surging again, with some medium-sized ships fetching more than $100,000 a day in Europe. That's some more good news on oil tanker rates. NVIDIA gives us the middle finger. So there's the middle finger there. And it is breaking to the downside. Are we going to get a big move to the downside? Some people say that this gap will fill down at $310, which is a 30% decline. It's a pretty big move to the downside, 25% or something like that. So NVIDIA does look a little bit weak. Uranium says, I spoke with several nuclear fuel buyers at a private event in New York City last night. Majority are anticipating $100 plus pound per uranium by early December, then much higher in 2024 and beyond. The biggest takeaway is they don't care about price. The concern is there's no uranium left to buy. It's from Uranium Corgi. We'll see how legit that is. I don't know. But I agree. I think uranium is going to be resilient. I think it will continue to slowly move on up. William says, no problem. A central bank gold revaluation fixes this immediately. Says the Fed is insolvent. So is the ECB and the RBA and the Riksbank. Is it a problem, and how can we deal with it? Well, just reprice gold. There you go. Boom, solved. Kim.com says 600 billion in new debt in 1 month. It's over soon. Doesn't matter what the next US president is. Our deficits are ballooning. 600 billion in new debt in 1 month. That is crazy. That is crazy. Silver, nothing happens. Then it happens all at once. Nothing. Then you break that resistance line, and then it all happens. It all happens very quickly. These $600 billion deficits in 1 month, it's going to get accounted for in the price of gold and silver and platinum. You know how much our standard of living is going to change if we see these prices move the way that a lot of us think they're going to move. The price of silver, the price of steel, iron ore, um, they're all going to go up, and our standard of living is just going to decline. Much like my interview with Peter Schiff and a lot of these other people that I have on here, they're all in agreement that there's going to be a large decline in standard of living if you're not positioned for this commodity bull market that's coming. A nuclear engineer seems to confirm the fuel shortage issue of French power plant, got uranium. Says, in all my years in this business, thus is the very first time I've seen a reactor shut down due to fuel shortage. There will be more like this, sadly. I wonder if that's actually true, though. I mean, are they really shutting down a French power plant because of a fuel shortage? I don't know. New, the true cost of fueling an electric vehicle, including excess charging costs and subsidies, is equal to $17.33 per gallon of gasoline, a new analysis found. So this is subsidies and excess charging costs accrued by a My 2021 electric vehicle over 10 years, expressed in terms of the cost per equivalent gallon of gasoline. So the cost of EVs is $17.33 per gallon of gasoline, given all of the subsidies in the system. Now, some people will say, well, it's not coming out of my pocket. Well, it is. It's coming out of your dollar, and it's going to come out of the purchasing power of the dollar. And that's where all of this is going to mount that pressure. So they're going to say, oh, it's not coming out of my pocket. There's nothing going in your pocket that's going to be worth anything that's got green color and dead people, dead presidents on the face of it. So they're just going to suck the value out of the currency. That's what it's going to come from. And that's just an aggregate that I'm talking about. When we aggregate, when we I think somebody called it self-mutualize, when we take all of the decisions of America and then we disperse bad decisions amongst everyone, where it gets hit is the currency itself. So when we socialize bad ideas, socialize bad policies or whatever it is, it all mounts at the value of the currency if we're going to socialize the losses. Uranium narrative has made headlines again. Prices are now back above the levels seen before the Fukushima incident in March of 2011. This is an asset class to keep a close eye on. So again, the uranium price above Fukushima levels, and we could get a pretty big move here. As we break away from these resistance levels, again, there's less overhead resistance. The moves can be and will be bigger at faster rates. So what is my approach? I'm going to sit in uranium and do nothing. I'm going to do literally nothing. I'm just going to wait for this to play out because the big money is made in the waiting. In the waiting. This is gold in world currency units. It shows that silver, this is silver, sorry. Silver, priced in major fiat currencies, shows the collected fiat picture for silver. What do we have? Well, it's sitting right below a neckline of a 12-year inverse head and shoulder. Shoulder, head, shoulder. We're ready to break out at any second. There's a lot of commodities that are right at necklines and ready to break out. One that comes to mind, you've got obviously silver here. We've got a lot of inverted head and shoulders and energy that also, they're just all over the place. It's scattered everywhere. So energy's got a lot. I see it in all the base metals to some degree, like copper and rare earths and some of these other ones. They're sitting there. Coal broke out and it's back basing again. So that's already broken out, but it's coming back to its base for a big retest. A lot of opportunity out there, guys. Another one that just recently broke its base is natural gas. So he says these widths really shouldn't have let inventory hit zero. Probably serves as a wake up call to others in the uranium industry that just in time doesn't work in nuclear, and inventories need to rebuild from 2 years back to 5 years, or about 600 million pounds of incremental restocking. Gonna be wild when they all do it at the same time, and that's your squeeze. It's when people panic. They're gonna say, "Crap! I don't know if I can get any uranium. I don't care what it takes, just get it." And that's when people panic. Says, I must admit that I did not expect this type of measure so early in the decade, but this is just one of several to come, mainly in the West. There will not be enough nuclear fuel for everyone. And wow, it's not like we haven't been talking about this on the channel for a long time. We knew that there's going to be a squeeze. Scott and I talked about, maybe we get over $1,000 a pound in uranium. It depends on what the squeeze looks like. It depends on human psychology. And then other people will respond, we can get, $200 a pound uranium from seawater. And I just shake my head. I shake my head, guys. I shake my head back and forth. And I just think, what type of short bus did this person ride? And it's no offense to people who ride on short buses. But it's like, guys, this is all about timing. It has nothing to do with the break even cost of anything. It deals with the psychology of people, it deals with inventory levels, and how fast you can restock inventory. The break even can be whatever it is. It doesn't matter what the break even is. It's the lead time that's involved to get new supply online. And if there's a gap, what does that gap look like? How long is the gap? And what are people going to do during the gap? So if there's a 2-year, 3-year, 4-year gap between visible inventory and inventory that's in stock, and the inventory that to replenish it is 2 or 3 years out, and they only have 6 months of inventory, what are they going to do? They're going to panic. And if you get enough people to panic, other people will panic. And then when all the people panic at the same time, that's when you get the big squeeze. And then all the financial people are going to jump on it. Why? Because people are panicking. And then you're going to get Reddit and all these other people are going to pile in because they're going to see price movement. Oh, shiny thing. Oh, let me go check out the shiny thing. Oh, look, it's going up. Oh, let's go check out why that sector is going up. Oh, there's a squeeze. And then the rounds, it'll go around the internet and people will all jump on it. They'll put a bunch of money in it. Because it's important to remember that there is no recession. There's only a recession amongst the money grifters in venture capital, PE, CRE, etc. The real economy remains white hot. Focus on nominal, not on real GDP. So he's saying focus on the nominal. So it says U.S. economy reportedly grew by 5% in the third quarter. Puppy knows emerging markets. Focus on nominal and the money being printed, not the real GDP. Nominal is the value of the transactions. Real GDP is the actual output of the economy. So you can have the same actual output and have nominal go up because the value of those transactions goes up because of inflation. That's what he means by that. This guy put the blueprint for BTC. I just thought it was a cool fractal overlay. I don't know if he's going to be right. I kind of think that this is going to keep going up. But again, I'm not the expert in Bitcoin. And we haven't had a clear turn yet. But he could be right. Maybe we have one pullback. Maybe there's a slowdown in the market. Maybe Bitcoin and gold and everything feels the slowdown. I don't know. I'm riding through it either way. I put in here uranium's laughing at all the other sectors. The other sectors have been quite weak. The S&P, Google, Meta that we just looked at, all those down ones. But uranium, it's been chugging higher. We broke that resistance line and we basically ripped from that resistance line that I'm pointing to here. I've got an overlay. The blue overlay is a fractal. It's a repeating pattern from the last commodity bull market that I put over this current bull market for uranium, and that would be the projected price when you basically extend it outward to go over the current fractal that we've got. Wave 1, wave 2, and then we've got a big wave 3, potential blow off wave 5. And again, this could be scrunched up where it's closer together, or it could remain a little bit longer where it takes a little bit longer time. And then we've got URNM that's also broken to the upside, which looks fantastic. I talked about TTF Dutch gas yesterday. It broke out big time today. It broke out to the upside. So that's looking really good. Here's TTF, big picture view. We came on up, pulled on back, and now we're starting to round this and break its bottom here. So TTF looking pretty strong. Gold still looking solid, still waiting for the launch, and we're sitting on top of all of these resistance lines. Looks fantastic. Silver still squeezing up, along with platinum squeezing up. Those are squeezing up, just waiting for gold to hit it. I talk about the big boys are starting to feel the pain now. Google and Meta are the two that I used as an example. We kind of squeezed up, broke down, retest, and then hoop into the downside for Google. That's a bigger picture view. Is this a double top? Kind of looks like it to me. Meta also breaking down. There's it zoomed in, breaking through its support level. Potential downside is there. Interest rates are starting to weigh on the overall stock market. So we've had high interest rates. You can see that we've broken this uptrend line. There's your peak there, your high. And there it is, ripping to the downside. It sold off further today. Today is 1026. So it did sell off even more. NASDAQ is in the same situation, and we are breaking down in the NASDAQ as well and selling off. This is what made me kind of look at it. Google stock is now down 10%, posting its worst day since March 2020. Nearly a $200 billion in market cap has been erased today alone. Big selling pressure there, guys. Boom, boom, boom. And this is what usually starts major pullbacks. Big selling pressure, big elongated candlesticks. That's generally the beginning of a sell-off. Tavi says, despite the ongoing debates, the current economic cycle has unfolded much more like the 70s period than World War II era up to this point. To put into perspective, during the 40s, the 10-year yield never surpassed 2.5%. Today, we are essentially double that. Okay, essentially, we are double that amount. And meanwhile, policymakers don't seem to be expressing any immediate concerns. In fact, after numerous public statements and appearances, Federal Reserve members have frequently emphasized that the rise in long-term interest rates is instead contributing to their objective of tightening monetary conditions. Ultimately, the playbook of the 1940s will inevitably be put into action given the unsustainable nature of the debt problem and the necessity for the Fed to suppress interest rates in today's environment. More importantly, regardless of whether you align with the 40s or the 70s perspective, hard assets will likely be imperative for investors in this current cycle. That's gold price versus 10-year yield in the 1970s. We had new home sales surge higher. So U.S. new home sales surge to the highest level since February of 2022. New loan growth, guys. Now, again, you can get a little bit of new loan growth when houses rotate in the economy of existing stock, existing homes. But the majority of inflation comes from new home sales. That's a new loan against a new asset. The new residential sales rose 12.3% as homebuyers continue to turn to builders for homes. That's your shortage. That's where they're going to turn if there's a shortage in the market, is to go buy new homes. That's where the inflation is being driven from. Powell is trying to stop that inflation. That's where the root of the inflation is, in my opinion. So that's where we're going to end it, guys. That's what I've got for today. Give me a thumb up if you haven't already. Subscribe to the channel. I do have the daily updates, and I've got these updates that I move in between different interviews that I bring on. All right, guys. Well, that's what I've got for today. We've got a question and answer session coming up on Saturday, 7 a.m. Love to see you guys there if you're a member. And we'll catch you later. This is Finding Value.